Hey guys, welcome back to 10-Minute Investing. I want to dive into one of the most popular investing strategies. I personally use it, and that's growth investing. And I will show you 6 growth stocks I personally own and what my thoughts on them are, if I'm going to keep investing in them, am I selling them, am I just going to hold them? I will let you know today. Before I go in, little intro, who am I to teach you investing? My name is Bojana, I'm based in Chicago. I've been investing for the last 3 years, and I've spent about a year before that just learning how to invest. I manage over $33,000 in different portfolios, and now I'm explaining investing to people who also want to get into long-term investing, just like me 3 years ago, and want to build wealth on the stock market. So if you're interested in investing explainers, subscribe to my channel. So first things first, what's better, growth stocks or dividend stocks? And I already did a video a week ago where I explained everything you need to know about dividend investing. Click here or click below in the video description and watch that video. It's just 10 minutes long. You will be thankful. But I want to dig into growth investing a lot more today. Growth investing means buying growth stocks, basically. That easy. What makes a stock qualify as a growth stock though? For me, the biggest indicator is the rate of growth return of the stock in the past 5 years. You can check it here in the stock quote. If you look at the stock quote and click on the returns tab, 5 years specifically, if returns are above the S&P 500 average, then it's definitely a market outlier and hence the growth stock. So basically 10% or more, whatever the return was that year. Like Accenture here, for instance. However, for me, since I'm a young investor with 20 plus years of investment horizon, so I look for returns that are higher than 100. So it's super growth stocks basically. Like Apple here with almost 200 5-year return. Then there are 2 more markers of a growth stock on top of the higher than average return. Those are, first of all, growth in revenue and profits year on year. I will explain where to check for these later. Another thing is low or absent dividend. Usually growth stocks don't pay any dividends or pay very little ones. Again, I will explain where that can be found in the stock quote. And unlike dividend stocks, growth companies reinvest their profits, so they barely pay dividends, if any, instead of distributing them as dividends to investors like dividend stocks, dividend companies do. Now, what about growth stocks and growth investing, pros and cons, especially in comparison with dividend stocks? First advantage of growth stock, I would say, is again higher than average return long term. AKA, if you buy a growth stock, say Meta, and hold it for 10 years, if things hold up the same way at Meta as they do now, so they have growing revenues, profits, etc., you will earn much more money on the stock than on a Coca-Cola stock. Based on this historical performance of Meta, it showed 182% return in the last 5 years. 5 years ago, Meta stock cost 200 and something. Now it's almost 600. That's almost triple growth. It's impressive. And Coca-Cola showed less than 60% growth, which, by the way, not bad still. Very good for Coca-Cola considering it's a value defensive stock, but obviously much lower than Meta. Now, past returns are not a guarantee of future returns. As an investor, you must always remember that, but they are a good basis for making decisions for what assets to add or not to your portfolio. So keep those in mind. Another advantage of growth investing, it's great for younger investors who have decades of time before they need to withdraw the money ahead of them. Why is that? And that leads me to growth stocks cons. Growth stocks, they are very volatile, and they're more volatile than dividend stocks. And when market dips or crashes, you can lose much more money short term when you have most of your portfolio in growth stocks. And the price of the stock goes up and down all the time. Again, for instance, if Meta stock costs $600 now, it can lose more. It can lose $100, $200, $300, but Coca-Cola costs $71. You can't lose more than $71. It's already not a super expensive stock, and you can't really lose that much because it's a much cheaper stock. I hope that's clear. The beauty of investing is that you only lose as much as you invest. You don't lose more. So if you don't want to lose too much, you have to consider the fact that growth stocks might also bring you bigger losses compared to dividend stocks. And the last disadvantage is that no income, no dividend, right? So you make money on a growth stock when the price goes up, but you don't get money in the midterm, right? Short term. And you also need to, if the growth stock does pay a dividend, to get at least $1,000 in dividends per year, you need to invest hundreds of thousands of dollars in that one growth stock, which is not practical for most investors. To sum up, if you have years and decades to invest and can't wait and don't need passive income right now, your investing strategy should rely on growth stocks. And if you're nearing retirement and want to generate passive income regularly, you don't want to worry about volatility, you should opt more towards dividend stocks. Now, where do you look for revenue, profits, price to earnings ratio, and dividend yield to identify whether a stock is a growth stock? Go to Google Finance and search for a stock. Let's take Apple again. First of all, you will take a look at its 5-year return here. If it's above market average, and especially if it's above 100%, then it's growth stock. Second, you will scroll down to income statement and choose annual and look at the revenue, net income, and earnings per share. Is it growing year on year? In Apple case, we see that the last few years revenue and profits weren't growing that much, but earnings per share are up 10%. That's great. That also qualifies for it to be a growth stock since key revenue and profit metrics are up. And finally, you'll scroll up dividend section. Apple does pay almost 0.5% dividend, which is very small dividend, so it doesn't qualify to be a dividend stock. So I hope that's clear on metrics. And you can dig into even more stuff. Is the company funding any innovative projects, stuff that can bring it even more return potential? But these 3 should be enough for a quick check. Now, let me show you 6 growth stocks I personally own and why I believe in them, why I still own them. First of all, Apple. Again, I've just explained its metrics, so I won't go into any more detail. It's a solid growth stock, and if you check on tradingview.com, Apple is actively developing services as revenue source as well, instead of just focusing on iPhone. So it's a great move and can really keep the company's earnings growing in the future as I hold the stock. So I will hold Apple, but I'm not buying any more of it in the nearest time because PE here is really high right now. It's 33.91. If it goes down to at least below 25, I might buy a bit more. Second stock is Chubb, insurance stock. Super solid though, not tech, but super solid. Almost 200% return in 5 years. Not a very high dividend yield, but both profits and revenue are growing in the last 4 years. And if you look at tradingview.com, the company's revenue does not just come from the US, but many other countries around the globe, global life insurance. So I believe that expansion to global market is what makes Chubb grow that fast compared to other insurance stocks. And I will hold and buy more of Chubb stocks this year because its PE is just 13. That's within industry range. So I like that. Third stock is Google. 5-year return over 100%, 0.5% dividend yield. Revenue and profits are growing over the last 4 years. Most revenue comes from digital ads and stuff, but cloud business revenue also keeps growing, and Google is betting on AI, so I think it will keep growing aggressively in the nearest time for sure. And I will also be holding and buying more of Google stock. 18p is great, lower than tech industry average, so I will keep buying it. Eli Lilly is a pharma stock, had explosive growth due to weight loss drugs here, 400% growth. That's crazy. And it's a big, strong pharmaceutical player in the US market, not just due to the weight loss stocks, but other drugs in its portfolio. They have a strong pipeline of drugs as well as like mental health. So I think I'm more confident in this company than Novo Nordisk, their rival in the weight loss category. And they had explosive revenue and growth in the last 4 years as well. And PE ratio is concerning though, 67. That's too high. That's why I will not be buying more of this stock. I want it to drop much lower. And fifth stock is Meta, obviously. Facebook, Instagram, WhatsApp, almost 200% return in 5 years, very low dividend, but growing profits in the last 4 years, except 2022. They had some sort of fallout with Apple then, but they rebounded nicely in the last 2 years. I don't like particularly that Meta stock comes not from very much diversified sources, but I think they are also betting on AI, and I think they will keep growing. Also, P just 22. I think I will be picking up more Meta stocks thanks to that lower kind of PE. And sixth stock is Nvidia, obviously. AI, leader in AI. That's why almost 1,500% growth in the last 5 years. That's crazy. Profits and revenues are growing. And even though PE dropped to 37, I will consider buying more NVIDIA stocks only when PE drops again at least to 25. I don't like the 37, unfortunately, at this point. And that's that on my favorite growth stocks. Are these the only growth stocks out there? Absolutely not. But they check key boxes: high returns, stable revenue, and profits growth. You can mix growth stocks and dividend stocks, by the way, depending on your goals. I personally hold mostly growth because I have more time to invest, but I like to sprinkle dividend stock here and there. If this breakdown helped you, give this video a like. I really appreciate every single viewer. I just recently started this channel to shine some light on investing for beginners. So hopefully it makes sense. Hopefully it's useful. And please subscribe if you're interested to watch any more videos from me. And I will see you next week. Happy investing!